I look at this situation and I kind of salivate. Our yield on that swap trade that you were talking about is over 4.5%. This is a 20-year bond. So we're not looking at the next 3 months or 6 months. We're looking at 20 years.
You're listening to The Real Investment Show.
So one of the big concerns over the last year or so has been rising interest rates and, of course, bond prices, et cetera, and big concerns about, inflation's going up, so now interest rates are just going to keep going up forever. We're moving back into this new phase of the economy like we saw in the 70s, and there's just massive differences between where we are today and where we are back in the 70s. As Michael Lebowitz addressed earlier, debt as a function of the economy was very low back in the 60s and 70s. Economic growth was running on average at 8%. Savings rates were very high for households. We were 80% manufacturing, 20% services, which had a very high multiplier rate in the economy. Vast differences with what was happening with interest rates in the economy back in the 60s and 70s versus where we are today, where we have massive amounts of debt, deficits, very low production quality, and of course, an economy that's almost 80% services and 20% manufacturing, which leads to lower wage growth and weaker economic statistics over time. And again, this is when we talk about growth rates running between 1.5% and 2% going forward. Even the Fed's own forward prediction for long-term economic growth rates is 1.8% right now. So again, not great. That's not great. But importantly, when we look back, bonds have been under a lot of pressure over the course of the last year and a half. And when we look back in history, and Bank of America did this really great chart just recently, going back to 1787, there has never been a period where you had a negative return on bonds for 3 years in a row. And the reason for that is that interest rates impact economic growth. The higher the interest rates are, then the more drag you're going to have on the overall economy when the economy slows. And as we've discussed here on the show many, many times, there's a very high correlation, an obvious correlation between interest rates, inflation, and economic growth. You can't have high interest rates and low economic growth. You can't have high interest rates and low inflation. And the reason is that the bond market is pricing for those things. The yield that is reflected on bonds is what is driven by their outlook for economic growth, inflation, opportunity cost, all those type of things. That's what the lender is factoring into the rate that he charges. It's also based on what he can actually loan money at, what people are willing to pay for that debt. So again, this is why we look back over time, whenever you have high interest rates in a period of the Fed aggressively hiking interest rates, what do you have every time following those episodes? A recession, lower economic growth, lower inflation, lower interest rates. And so this is the reason that Mike and I have been talking about a lot lately, and we wrote about it last weekend's newsletter. We talked about it on our podcast, that we've been analyzing our bond portfolio very deeply and looking to make a bond swap. And so yesterday, we actually did that bond swap. We swapped our holdings in TLT, which is the 20-year iShares Treasury Bond ETF, into an actual 20-year Treasury. And there were some reasons for doing that, and we'll get into all those this morning. But before we get into that, Mike, any comments you want to make?
No, I look at this situation and I kind of salivate. You're picking up such our yield on that swap trade that you were talking about is over 4.5%. And this is a 20-year bond. So we're not looking at the next 3 months or 6 months. We're looking at 20 years. And when you look at 20 years, you're looking at long-term economic growth rates, at productivity rates, at demographics. They all point downward. The Fed tells us they're downward. There's nothing to hide. We know, with relative certainty, barring something major that's going to change the way our economy runs, that the growth rate will be over those 20 years probably below 1.5% on average. And to pick up, 3% on that rate is not a once in a lifetime, but those opportunities don't come around.
Right.
And, go back from the financial crisis to the pandemic, you were lucky to get a positive rate, a positive bond yield over the rate of economic growth or inflation. Now you're getting paid 3% and everyone's running scared.
But that's usually the case, right, Mike? I mean, when stocks are going through a major market meltdown, nobody wants to buy stocks because they assume that the stock market's going to zero. We'll go back to 2008. It's a good example of that. In 2008, stocks are declining, and everybody's predicting that the stock market's going to zero, and so nobody wanted to buy stocks at the bottom of the market. But that was the opportunity to buy something. And again, here we are once again, the vast majority of the mainstream media coming up with every reason why interest rates can only go higher from here. But there's simply an economic connection to interest rates that suggests that is not going to be the case, and history says that. Now, I want to make one thing very clear, though. Mike just said that we're looking for the next 20 years out, and there's a couple of points that he's making here is very crucially important. The first is that I can't tell you how many people come along every day and say, boy, if I could just get 5% on my money, I'll just lock it up and go home for the day. Well, here you are, 4.5% on your money. That's pretty close to 5. It's within spitting distance. And so here's an opportunity to get 4.5% on your money for the next 20 years with an absolute guarantee of repayment of your money. No principal risk whatsoever. This is termed a risk-free investment because it's a government bond. The second thing is we have no intention of holding it for 20 years. So when we go through the next market decline, when interest rates do fall and interest rates come in line with long-term economic growth projections, then the price of this treasury will have appreciated to the point that we will have maximized the capital appreciation out of this bond, and we'll be able to sell that for a capital gain. And at that point, most likely, this will be the point where nobody wants to buy equities again because we'll have gone through a recession and an equity downturn and markets are down substantially. The mainstream media will be wringing their hands about why the stock market is only going to go lower from here. But when we reach that low point on interest rates and inflation has declined and economic growth is in a recession, that's when we'll want to sell this treasury. We'll have maximized the price appreciation, and then we'll want to be buying equities cheap because valuations will now justify owning equities over fixed income. Mike, fair statement?
Absolutely. Yeah, I'd be shocked if we own this thing for more than 3 or 4 years. Likely at some point we are going to have the recession I think we're going to have. Stock prices will go lower. Bond prices will go much higher. Bond yields will go back to where they go during recessions, which there was a 10-year bond at 0.5% not that long ago.
Yeah.
So, yields fall and we work out of the bonds and back into stocks and take advantage of lower stock prices and, the capital appreciation on the bonds themselves.
So there's also a couple of other reasons why we elected. So we could have done a couple of things, and we had talked about some different ideas on the show, and we'd written about some different ideas in the newsletters and as well as our weekly blogs. And we've been covering this topic a lot over the last really month or so, talking about bonds and interest rates. And I've got another article coming out on it next week as well. But the point is that we did a lot of evaluation. We talked about potentially swapping one ETF for another, and maybe extending out duration and buying a different ETF that had a little bit more duration to it. There were kind of 3 reasons ultimately that we settled on just swapping it for an individual bond. One was obviously that as opposed to an ETF, when you buy an individual bond, if something goes horribly wrong, and let's say that Mike and I are entirely wrong, we're about to enter into the greatest growth dynamic of the economy that we have ever seen. Socialism works. And, we have the capitalist experiment dies and we just blast off into a world of prosperity never before seen on the planet Earth. And interest rates rise because of that economic prosperity. Well, in 20 years, we will get paid back all of our principal, right? No matter what happens to interest rates, there's a guaranteed repayment of principal that you don't have in an ETF. The second reason is that we reduced expenses to the portfolio. The bond carries no expense ratio. So the ETFs, they have an expense ratio, they have an operating cost, et cetera. So we've now eliminated that part out of the bond portfolio as well, reduced expenses to the overall portfolio. And then lastly, of course, we have a guaranteed set of income coming in now. So the income paid by the bond will feed directly into our client accounts. Now, one disclaimer here. In our SimpleVisor portfolios that we run, we did the ETF swap. We went from TLT to EDV, which is the Vanguard long duration bond. The reason that we did not do an individual bond in SimpleVisor is because we don't have a way to track the daily prices of terms of a data feed in SimpleVisor. So for performance reporting purposes inside of SimpleVisor, we had to use the ETF. So again, you won't see it in SimpleVisor, but in our client accounts and our managed accounts that we run, we did this swap from TLT to an individual 20-year Treasury bond.
So we also added about 25 basis points, 0.25% of yield versus TLT. And that's because there's somewhat of a unique opportunity. When you look at the yields of the 20-year bond versus the 10-year bond and the 30-year bond, you pick up 30 basis points over the 10-year and 20 over the 30-year. So not only do we pick up extra yield because there's kind of a sweet spot on the curve right now at the 20-year point, but we also eliminate the expenses. So we're picking up, I think it's more than 25 basis points in additional yield on top. And, like I said, we got over 4.5%. Yeah, I love it. I love it.
Exactly.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.